This is 11 to 40-ish, mathematics of estate tax planning and more. I'm Alan Gassman. This is Brandon Ketron with me, my partner. We are in Clearwater, Florida, not Burbank, California, but we're still going to try to give you a really nice show here. This presentation does not qualify for continuing education credit. In fact, if your accrediting organization finds out that you've seen this presentation, they may take a 1-hour credit away from you. But there will be 1 hour after this event is over, you will receive an email with attachments enclosing a lot of the things that we're going to talk about today. And one of the things we're going to give you is not only the PowerPoint slides, but also some really cool Excel spreadsheets, which we reviewed last week and which we have improved for you, and also a new article that we've just published on the Lineberg network, for Bloomberg. This slide here is a LISI Lineberg Information Services 90-minute talk that we gave for professionals, which will air on the 19th. And if you want to see it, I'm sorry it's not free, but we're going to cover a lot of what we talk about on the 19th here. Please join me Wednesday the 19th also to talk about charitable giving to private foundations and how private foundations help donors help public charities. And then if you're in Michigan, you can catch me at the pre-bankruptcy and bankruptcy avoidance talk for the Michigan Bar Association. So we are also today going to talk about, at the end when we're done, we're going to take a slow look at the Estate View software. So those of you who are using the Estate View software can get some good pointers on how it works. So here's a chart on page 13. We've talked about this chart many times, but it's a good basic chart to show that when a person dies, the first $11,700,000 worth of assets can pass estate tax-free. And then everything above that, there will be no estate tax if you are fortunate enough to have a spouse or a charity that you can leave that to, or to a marital deduction trust. And then on the second death, the surviving spouse will count their assets plus whatever is in that marital deduction trust, and that will determine his or her estate tax. Now, the exemption is scheduled to come down to half in 2026. So it's going to go up with inflation, but then come down to half. And of course, Bernie Sanders would like to put it down to $3.5 million. On the left-hand side, we have irrevocable life insurance trust to get the life insurance out of your estate. The life insurance is not going to be estate taxable on the first death, but it's going to add to the value of the surviving spouse's estate or reduce what they call their portability allowance unless it's in an irrevocable life insurance trust. So irrevocable life insurance trusts are becoming very popular. Now, later in the presentation, I hope to show you exactly how to use these spreadsheets. And we should have a guest here. Grace, are you on?
Yes, I am here.
Okay, so Grace is a law student at Stetson Law School. And Grace and I are writing an article called Mathing Out Estate Tax Planning Strategies. And I apologize that Grace's camera broke. It's not because Grace is unattractive. It's just because her camera broke. But Grace, how would you guide us? How would you explain these PowerPoint slides and our article?
Thanks for that introduction, Alan. So I would explain this article and these charts as just a way to map out all the different possibilities and legislative changes for really any client that you may have. So Alan and I have been able to run these numbers for what the tax exemption may go to in the future, and we've been able to run it for retired couples who may have 20 million in assets, or we've been able to run it for middle-aged couples who still plan on working for a few more years and actively saving. And we've even been able to run it for people like me, whose net worth is approximately zero, and being able to see if maybe one day I might have an estate tax exemption issue. So it's been really cool to be able to see all the numbers auto-populate and really show you what your client's situation may look like.
Okay, so do you want to explain what these columns are? I'm on pages 22 and 23 of the PowerPoint. You want to go over what these columns are, if you recall?
Yes. All right, so the first column we have the exemption without reduction. So the current tax exemption per person is 11.7 million. So we've doubled it here to fit for a married couple. So you can see in 2021 that starts with 23.4 million, and then it's going to increase at 2.5% inflation. And so that's one possibility. The following column is if the exemption goes to half in 2026 and then continues to grow with inflation. So you see it grows for the first 5 years the same as the previous column, but then after that it gets reduced down to around 12 million or so and then continues to grow with inflation after that. And then the third possibility that we mapped out is if the exemption reduces to 3.5 million in 2021 and then grows with inflation to 2.5 million. And then you can see with our example married couple, you can see how in the following columns, how those different scenarios are going to play out. And obviously, that first green column is going to be much more advantageous for this client based on that exemption staying the same.
Right. So and then in the next column, if it goes to half of the exemption in 2026, you see some significant estate tax beginning in 2026. And then in the blue column, Bernie Sanders' plan, you see a lot of estate tax immediately. So just to review the buttons, and everybody's going to get this PowerPoint, all you have to do is open it up in Excel as an Excel document when you get it in about an hour and a half. And you can take this married couple and you can start with whatever net worth you want. You could start with Grace's net worth of zero. There you go. There's Grace. But then if Grace works for us and can bill 4,000 hours a year at $300 an hour, then she'll be making about $320,000 a year. And then if she can invest that at 8%, then you see that she becomes estate taxable in 2053. So Grace, you only have to save $480,000 a year and invest it at 8.25% with your spouse in order to have that estate tax occur to you. But this also shows me that even a couple at 8 million, if they are saving, let's say, oh, by the way, you have to save this for a number of years. If they're saving 280 a year and they start at 8 million, you see they hit that estate tax pretty hard. So use this tool. And one thing I like about this tool is I just met with a client and their net worth was about 3 million. So I'll go down to 3. And they feel like they need 6 million in order to retire. So the question was, how much can you save? Can you spend a little bit less? Because to get to 6 million, if you can save 260 a year at 8% rate of return, or let's get more realistic, a 7% rate of return, then you're going to hit 6 million in 7 years. So hope you enjoy that. Now, the next thing that we did with Grace was we looked at the qualified personal residence trust. And with a qualified personal residence trust, I'll just open this one up. You take your home and you put your home in an irrevocable trust, but you have the right to live in the home for a period of years. And in this case, we have a married couple And let's say that their home is worth $2 million. I'll toggle up to 2 million. And let's say that the rental value of their home is 7% of the value. The home's growing at 3% a year. Well, what the heck? Let's say 4% a year because inflation's coming back. And it costs, when they put the home into a trust based on their age 70, a $2 million home into a trust where they the use of the home for 10 years is a gift of approximately $1 million, according to the estate tax tables. So we'll have to change this this up arrow, Grace, so it doesn't take 9 weeks to get up to $1 million. All right, let's get the house down then. We'll get the house down to $1.5 million. So then they use about 650 of their exemption, and they get to live in the house tax-free. They don't have to pay anything to live in the house. The house is still considered to be theirs for income tax purposes. So if they sell it, they still get the $250,000 per person exclusion on the sale of a home. And what happens is in year 11, the home is worth $2,220,000 and it is out of their estate. So if they die in 2011, then the estate tax savings getting the home out of their estate at 40% is $695,000. That's after taking into consideration the use of their estate tax exemption, their gift tax exemption. But then they start paying rent. They pay rent based on 7% of the value of the home, which is pretty typical. So in year 20, not only is a $3 million home out of their estate, but also the rent that they've paid reinvested at 7% is worth $1.8 million. So they have taken $5 million out of their estate for estate tax purposes. They haven't had to move hardly any money. They haven't had to do anything complicated, just deeding half of the house into one trust by the husband in our situation, which benefits the spouse and descendants. And then the wife in our situation put half of the house into a trust for descendants only, waiting the 10 years, staying alive the 10 years. If you die during the 10 years, you don't get any benefit, but nothing bad happens. It's just that the house is in your estate and you're not considered to have made the gift. So Grace, anything you want to add to that? I really think you did a really nice job with this spreadsheet.
Yeah, thank you. No, I think you covered it all.
Okay, so the way to find out how much of the gift exemption you use is normally only determinable using the IRS tables, which can be very complicated to use, or using commercial software, which is known as number crunchers and Tiger Table, are the ones that we use. Grace, you said you found a website that provides this for free?
Yes, I did. I forget exactly what the link is, but I'm sure we could possibly share that after the fact.
Sure, sure. Okay, sounds good. So another math item that we have not yet covered, but maybe Brandon, you'd like to cover, is the concept that if a client is definitely going to have to pay estate tax, and you know that they're going to have to pay estate tax, it will save their descendants a lot of money if they pay the estate tax early. And the reason for that is if I keep $10 million in my estate that I don't really need and I die with it, then Uncle Sam is going to take $4 million as the result of my death, leaving my descendants with 6. But if instead I give away $10 million today, then the gift tax I pay of 4 million, and in this example, if you assume I have no exemption, also comes out of my estate. So my estate is smaller by 14 million. So Brandon, how is it that that saves my children federal estate tax?
Yeah, so the real savings is basically the appreciation on the gift that you've made. So if you pay $400,000 of gift tax on $1 million taxable gift today, then 20 years from now, that $1 million might have grown to $300,000. So that's not going to be subject to estate tax because it's now out of your estate. You've paid $400,000 of gift tax, but you've saved the 40% on the the 2 million that is now outside of your estate. So that's $800,000 of savings right there by paying the gift tax early, allowing the appreciation to pass outside of your estate. There's other considerations as well. Rates could change, rates could go up or down. We don't really know what's going to happen there. But paying gift tax early could be a consideration, especially if you think gift tax rates might go up, if you think the exemption might decrease. This is a way to pay a little bit early and save some appreciation in future tax years.
Right, because the gift tax you pay comes out of your estate. So there is, even if it doesn't go up in value, there is a little bit of savings because of how the math works. And we thank Professor Jerry Hesh for this slide. But I guess we don't really know anyone who would actually want to pay estate tax in advance. But sometimes you make a aggressive move. You do a sale at a low price to a family member, and it might get audited and you might pay gift tax. And as long as that transaction happens more than 3 years before you die, the fact that the gift tax you pay is out of your estate actually saves your children money in the long run. Although it never is going to feel that way, I guess it's a consolation prize.
Yeah, that's always a tough conversation to have, is to intentionally do something that makes you pay more taxes with a client. That's an easy one.
Right. Now, page 32, this is, I think, pretty important. Interest rates are coming up. These are the rates that you can use for a interfamily sale or a loan. So if you had loaned your grandchild's trust $1 million on a 10-year note in January of this year, the note could have borne interest at only 1.35%. But if you make that loan today in May, it's going to bear interest at 2.15%. That's 0.8% higher. And you can see it's been going higher every month. So one thing you have going for you is if you make a sale, instead of loaning your grandchild trust $1 million, you sell your grandchild trust an LLC interest for $1 million. The regulations say that if you make a sale, then you can use the lowest of the preceding of this month or the preceding 2 months. So if we get these sales that we're working on now done by the end of May, we're going to have a 1.61% interest rate on our long-term notes. But if we wait until July, then we're probably going to have to use a 2.15% rate. Now, if you go with a 9-year note, then you can use 1.07%. And if you go with a under 3-year note or a demand note, you can go with only 0.13 of 1%. So these rates are going up. So all things being equal, number one, the concern that the House Ways and Means Committee may issue a proposed bill that would do away with the ability to discount or the ability to gift or make a sale to a disregarded income tax trust, leads us to believe that it's better to act a little bit sooner rather than a little bit later. So for a 73-year-old, you could also use what's called a self-canceling installment note. You could gross that interest rate up by approximately 4.2% of more than it would have been. And it goes for the life expectancy of the client. It balloons in 12 years. But if the client dies before it balloons, then the note is completely out of her estate for estate tax purposes. So a lot of times we're thinking, do we do a regular note or do we do a self-canceling note, or part regular, part self-canceling? And of course, the health of the client is important. The IRS does not like you to do this when the health is not good. So as we've explained many times on page 34, just to kind of warm up your brain for the SWAT planning, because then Brandon has a really nice new toy to share with you. We put $20 million worth of assets into a limited liability company. And at first, clients are joint owners of the voting interest, and they own 49.5% each of the non-voting interests. And we hire an appraiser, and the appraiser tells us that a 49.5% non-voting member interest is only worth $6,930,000 in this LLC because there's approximately a 30% discount. So the clients make a seed capital gift of about $700,000 to each of these irrevocable trusts. One is a spousal beneficiary trust, or a SLAT. The other is a trust for descendants. And then the clients sell their 49.5% each member interest to the applicable trust in exchange for the note. And this happened in January, so the note could bear interest at 1.35%. Now, the IRS may audit this and say, we don't agree with this discount. We think this discount is way too aggressive. We think it should be a 20% discount. So we think that you've made a gift. You said you only made a $700,000 gift, but we think you made a gift of not only the $700,000 seed capital amount, but also of approximately $1 million. So Brandon, what happens if we've used a formula clause here in our sale document, which is based upon the tax court case of Wandry?
Yeah, so there's a formula clause known as a Wandry clause, and the way the Wandry clause work is when you actually do the assignment document from the client that had the interest to the trust, the assignment's drafted in a way so that you're actually only gifting a defined value amount. So we would say in that assignment, I'm gifting a number of units in this LLC that are equal to $6,930,000. In the event that it's finally determined for tax purposes, that and we guess that the units, might be worth, let's say, $7,000 a unit. The math probably doesn't work in on that, but just for example, so we say there were 7,000, so we transfer 100 to take care of the amount of the 6,930,000. The IRS comes back and say they're not really worth 7,000, they're worth 10,000 a unit. Then we say, well, that's okay, because then I'm just transferring less units in the LLC because I only transferred that defined value. Whatever number of units it takes for me to get to that defined value, that's what I've transferred. And so that way, if the IRS doesn't agree with the valuation on a per unit basis, then the amount assigned to the trust is actually just reduced, and therefore you're not going to be making a gift above that promissory note. Now, there's an alternative way to do this, and so that's known as a McCord and Petter, basically a charitable overflow provision, where you do it in a similar way, except you make a transfer of the 49.5% interest, but you define the value that's going to the trust as the amount equal to the note of the $6,930,000. And then in the event that the valuation, as finally determined for gift tax purposes, might be $8 million, well, then the excess over the value of the note's going to go to a charity, and that way you get a charitable gift tax deduction and don't have to pay any gift tax on that excess amount. So there's ways to define this to make sure that the client is getting the amount in exchange back to what he's gifted, so there's no actual gift, and then the overflow can either be in a way returned to the client, or it may pass to a charity or potentially a marital deduction trust. So that way we avoid the further gift taxes if for some reason our valuation is off and the IRS does not agree with that value.
Okay, and so in other words, when you make this sale, let's say that this was a $200 million LLC and the note is 69 million, and the IRS says the note should have been 79 million, not 69 million. You've made a $10 million gift. Well, if you've used up part of your exemption, then you may owe gift tax. So these adjustment clauses become very important. So Brandon, what's your confidence level on a scale of 1 to 10 that the Wandry result, which was only a tax court memorandum decision, only one tax court judge said this, it's not binding on other tax court judges. How safe are we?
Yeah, I would feel comfortable with it. I think probably on a scale of 1 to 10, it might be around an 8 or so. There was another recent course, Nelson v. Commissioner, which was still unfortunately also just a tax court memorandum decision. And the problem with that is tax court memorandum decisions are just one tax court judge. It's not a full tax court decision. So it's not binding on future tax court decisions. It's really just what that one judge thinks for that one particular situation. So now we have 2 cases of tax court memorandums, and the Nelson decision agreed with the valuation and the defined value clause and said it works, but unfortunately the taxpayer just drafted the assignment document inappropriately, so it didn't adjust the way that they thought it was going to. I think that gives us a little more confidence that the Wandry type clauses will be respected. But the IRS's argument back against them is a public policy issue. They say if people are going to be able to define values like this, they're disincentivized to audit. So then there's no watchdog to enforce the the valuations and make sure taxpayers aren't doing anything squirrely. That's where McCord and Petter has a better value than the Wandry clause. So that's probably a 9 out of 10 on the safety scale for the McCord-Petter charitable overflow clause, because then if the excess is deemed to be transferred, the excess goes to a charity. So then the IRS's public policy argument doesn't work, and the fact that we can say charitable giving is encouraged, and there's actually appellate decisions that have supported the McCord and Petter cases, unlike the Wandry, and they have disregarded the IRS's public policy argument because they say we don't care, the excess goes to charity, the charity's there to serve as a watchdog to make sure everything's done appropriately, the valuations are done correctly, and make sure the charity gets their fair share, and we are going to encourage charitable giving. So the McCord-Petter is a little bit safer than Wandry, but it also involves a little extra work. You have to get 2 valuations instead of just 1. You have to have the charity actively involved in negotiating the documents. So a little bit more work to be done there versus just a simple Wandry clause.
So for the charity, we would show a separate charity on the chart, and we would show a small part of the LLC going to the charity. And we would also show that if it is determined that the interest sold was worth more than what we thought, then the overflow would go to the charity. So then you donate money to the charity so the charity can buy an appraisal, and then the charity may quibble with you a little bit over what they received and if they should receive more. And then if a tax court judge decides it was worth a lot more, it goes to the charity. So it could be a family foundation that you could establish, but that does make it safer for a larger estate. And let's remember what happens here. 10 years later, when the assets are worth 40 million and the LLC might have a business reason to dissolve, each trust ends up with $13 million from the LLC plus whatever the 700 it received grew to. So we've made $1.4 million gift here to move $27,400,000 out of these people's estate, and their estate is smaller than it would have been because they've paid the income tax on all this. So it works. It can work very well. So Brandon, where is our latest invention? I'm looking forward to showing that.
Let's see if I can share my screen here.
Oh, okay, that's right. It's not even in the PowerPoints.
I'll put it up. Can you see this now?
I think we do.
Okay, so do you see the LLC at the bottom with the 60 million value?
Yes.
Okay, all right. So we had a recent client come in. He has, around 60 million of assets, and he wants to do this installment self-planning to a spousal limited access trust for his spouse and descendants. But he also wants to make sure he can take advantage of both his exemption as well as his spouse's exemption. So the easiest way to do that is to make a $23 million gift and split the gift. That way you each use your $11,700,000 estate tax exemption, and you split the gift and everything's fine. But the problem being, if I simply just make a $23 million gift to the SLAT, my spouse is also a beneficiary of that trust. And the IRS says that you cannot split the gift if the spouse is going to be a beneficiary. You can only split the gift to the extent that the spouse does not have an interest in the trust, or it's very unlikely that the spouse would ever receive any distributions from this trust. So how can we structure this now to make sure that we can take advantage of the split gift and use the full exemption for both spouses? Well, we can start by doing our normal installment sale planning, where we aren't making a gift to the trust, but we're actually selling assets to the trust. So if you look at this with a $60 million value and a discount of 30%, the sales price might be $42 million. So we have a $42 million promissory note selling assets to the SLAT back to the client. Well, for just to be conservative, we want to make sure that the SLAT has sufficient assets to support the payment of those annual interest payments that will be made on the note, and also the principal at some point. So it's generally encouraged to do a seed capital gift to the trust. Well, if we do a seed capital gift to the trust, can it be split? Well, it can only be split if the spouse is unlikely to receive those distributions. So how else can we structure this? Well, one way to do this is to make the seed capital gift to a descendants only trust and have that trust guarantee the SLAT's obligations under the promissory note in exchange for a guarantee fee. That way we can split this gift over here for the descendants only trust because the spouse is not a beneficiary. We could also use maybe an old life insurance trust that has significant assets, pay a guaranteed fee to the life insurance trust, and that way we don't have to actually seed the spousal limited access trust. Well, in this situation, there wasn't enough assets in the life insurance trust to fully support the 10%, roughly 10% that we needed to have under the spousal limited access trust. So how did we do this instead? Well, we took the 1.5 million, we added 2 million down here to the descendants only trust. So now we have around 3.5 million. And we did a very small seed capital gift to the actual spousal limited access trust, but specified in this trust that this gift would be held in a separate compartment of the trust that would be held for the descendants only and not the spouse, so that it was still eligible for gift splitting. So that gets us the full 10% of assets that we really need as a safety measure to make sure the notes can be paid and supported when the interest payments are due. So now the client's owed a $42 million note, and what can we do with it to make sure we use all of the lifetime exemption that we currently have? Well, we can gift the actual note to a trust for descendants only and split that gift with the spouse. The other nice thing about this here is if I'm taking a note that's paying interest at 2%, and generally on the market, I could go out and maybe get 5, 6, 7% on a similar note with an arm's length party if I'm just loaning money to an individual. So you can discount the note because it's below market rate interest. So if we take a $23 million note, we discount it by 10%, the actual gift is going to be 21 million, which would be their remaining exemption amount. Client's worried though. He says, I don't want to pay any gift tax. I don't want to, pay the gift tax early. I know you say that could be helpful, but I just don't want to pay any tax. So what's my protection here if the IRS does not agree with this discount? If for some reason maybe this no payment becomes larger because of a purchase price adjustment clause in the sale agreement, where if the IRS says this should have been a $50 million sale, the note increases to $50 million. Well, we can do a similar formula type allocation where we say I am only gifting a defined dollar amount of my remaining exemption amount of $21 million to this descendants trust. Any excess over that amount is going to go to either a marital deduction Q-tip trust potentially, or a charity. So that way you either get a marital deduction or you get a charitable deduction on that excess value, and you're not deemed to be making a gift, and therefore no gift tax would have to be paid. So we have some sample language as to how that could be drafted, what happens and how the adjustment works. And so that way, and we can send this chart out as well as an attachment so everyone has it. So what does this look like when we're all said and done? Well, we have the SLAT with a 99% ownership in the LLC. It has a remaining promissory note back to the client of around 18.6 million. There's a $23 million note to the descendants trust. And then we had a little excess overflow of 333,000 to this marital deduction trust or a charity. So what have we saved? Well, if we did nothing with the current exemption level of 23.4 million, we would have roughly 14.6 in estate taxes. If it drops to 3.5, we would have $21 million of estate taxes. But what have we done here? Well, we've now reduced the value of the estate by 19 million. We've used our full exemption amount, but we only have now estate tax payable of 7.6 million. So you can see we've either saved 7 million if the exemption level stays the same, or 13.6 million if it drops to 3.5 million. So the use of discounts, the use of adjustment clauses to protect against the gift tax if the IRS doesn't agree with valuations is very valuable. Unfortunately, it's one of the things that the Bernie Sanders group is targeting to try to eliminate. So this type of planning may not be available in the next couple of years, but it is certainly something that we could do now, and the savings can be quite significant. So Alan, any comments on that?
No, let me just explain it one more time, because I'm sure a lot of people got lost. I probably would have gotten lost because it's a pretty brilliant plan. This is a situation where there's a wealthy individual in a second or third marriage who wants to take care of the spouse, but also selfishly wants to do that because he or she would like to be able to get half of the household expenses paid from this trust if things don't go well, or if they get estranged from the child or the children. So this person has $60 million worth of assets. We would like to discount all of them and freeze all of them so that we can get this estate as low as it can be. And we want to use this lovely spouse's $11,700,000 exemption. So we can't split a gift if the spouse is a beneficiary of the gift, or at least not safely. The IRS doesn't like that at all. So we keep the slat a very small gift amount, as you can see. It's a small gift amount because of discounts, but it's actually a very high value because of discounts. The slat, conservatively speaking here, is worth $18 million, which should be fine to help that spouse out. So the spouse feels pretty good about allowing us to use his or her 11,700,000 exemption. So we do the slat sale. And if it turns out that that's really a gift, hopefully our formula clauses save the day. But if not, the spouse's exemption and the client's exemption save the day. So then they wait. You either keep the note in place, maybe you keep it in place until early next year, so that you next year on a gift tax return only show the note. You don't show the sale you made in 2021. But then you want to use whatever's left of the spouse's exemption. Well, to do that, you've got to make a large gift that does not benefit the spouse. So that's to the descendants only trust, but a little bit can go to a marital deduction trust to benefit the spouse. One, so the spouse feels good. And two, you're using a formula clause, which says, oops, if this note is really worth more than I think it is, or oops, if my exemption is really less than what I think it is, then the excess will pour into the marital deduction trust. Now, you could end up paying gift tax as a result of this. One, the IRS just may come in and scare the living tarnation out of you. You say, okay, fine, I'll pay a little bit of gift tax, knowing that at least if you live more than 3 years after you triggered the gift tax, that you're actually saving estate tax in the long run. So, Brandon, anything to add to that?
No, I think that was good. I think it's just a very interesting plan. It just shows kind of all the, while we have a standard installment sale, plan that we've been showing, there's a lot of different variations and tweaks and turns that you can take off of that standard plan based upon client situations, and everyone is unique. So it's fun to chart these things out, play with it, and then see what the best scenario is for the client.
Okay, great. So how do I get my slides back here?
Let me flip it back to you. There you go, should have control now.
All right, let me see if I can. I want to mention something. One thing we're doing here is we're causing assets to go into trusts that may not get a step up in basis for income tax purposes. So people just need to understand that. We think there can be a step up when a trust is disregarded for income tax purposes and somebody dies, but the IRS probably doesn't agree with us. There's nothing really published explicitly on that, and Bernie Sanders certainly doesn't like it. Florida is in the process of passing a new community property trust law, which will allow Florida couples or married couples from anywhere in the country to set up a trust in Florida with a Florida trustee and designate it to be community property. And then under the laws of community property, if one spouse dies, there's a full income tax step up in basis. So if Marcia and I have $100,000 worth of stock that we paid $10,000 for, and I die, well, normally she gets a basis of $55,000. Half of it gets a step up, but not all of it. But now in a community property trust, if it works, and we hope it does, then I pass away and Marcia can sell that stock for 100 and pay no capital gains tax. So that's coming along. But remember that there's another way to do it that may be better, and that is the Jest Trust. So if you're with a client situation and the client wants the step up in basis, they're not worried about the estate tax. They've handled that, or they're well below 7 million for a married couple. Consider putting them into a joint exempt step up trust, or in Alaska, Tennessee, or Florida community property trust. So on the first death, you can have, or at least claim to have, a full step up. And I believe with both of these trusts, you can also provide that on the first death, all the assets in the trust, even though it was a joint arrangement, can fund a credit shelter trust. So I think once this Community Property Trust Act gets signed by the governor, which I think could be next week, I believe it goes into effect July 1st, then you're going to want to review the Jest articles that we wrote, Joint Exempt Step-Up Trust, and the articles on community property trusts, and decide which one you would like to do. Something else, we did a couple of these this week, so I just wanted to mention it, and more people want confidentiality as to what they own. So on the right-hand side, this could be your homestead. In fact, maybe that is a picture of your house. I love your trees. So instead of putting the house in the name of the client, where the property tax records show up, the name, we put the home in a land trust, and then we have an LLC become the manager, the trustee of the land trust, and the LLC goes on the property records as the owner of the house. And then the client doesn't own the house anymore, and at least on the property tax records. Now in Florida, we've had this in 6 counties, we've done this, where the property appraiser allows the company to be shown as the owner of the home on the property appraiser website, but allows the homestead exemption, understanding that the land trust is, the beneficial ownership of the land trust is owned by the client. Now, these are for rental homes here on page 96, where I don't like rental homes in my client's name because somebody breaks their neck on the front step, the client gets sued. You put it under an LLC. But the insurance carriers don't like LLCs. They want it under a revocable trust. So you set up the client owning the LLC, owns the revocable trust, and then a lot of the insurance carriers will write the coverage. So I think that we're way past 40-ish minutes on this, and I apologize that we started a little late, had a tiny bit of a technical glitch, and but I think we finished strong. Brandon, Grace, any final words here?
I'm good. I think you want to show them a state view? Yeah, there we go.
Okay, so Brandon, feel free to sign off if you have stuff to do, and I'm sure you do.
Yeah, I will probably take my leave. So thanks everyone for having us and tuning in again, and we'll see you next time.
Right, exactly. Okay, so this is the Estate View software. It was developed by myself and Jerry Hesh and my son-in-law, David Archer, who actually did all the work. He's a brilliant computer software MBA. So what you have here is a view of Bob and Mary Sample, and they're just like Grace. They have no assets and they have no estate tax problem. And isn't that nice? So I can go here and top left-hand side, I can put my law firm's name here, uh, Puppet Firm, and I can put my name, AM Puppet. And then I can give the client a name. Bob Sample's a great name. I can move the client's age to whatever age he happens to be. And then this tells me his life expectancy under the standard tables. If he's a non-smoker, 2028. If he's a tobacco smoker, 2027. And then I can give him a projected year of death. We could be sadistic here and make him go in 2027, right after the exemption goes down. And then his lovely wife, Mary, she can be 62 years old. She can be a smoker, and she's going to go to 2038. So I can move that to 2038. And then I'm going to give them a house, $2,500,000 house. And then I'm going to give them investment assets of, let's say, 10 million. There's my 10. And I'm going to let these assets grow at 7%. Well, let's say 7.48%. Annual investment costs. They're paying their investment advisor 0.5%, and they're paying income taxes of about 0.8% of the portfolio a year. And until he dies, until Bob dies, they're saving $400,000 a year. And after he dies, Mary will be able to save $50,000 a year. I'm going to assume that the exemption is, and I can go ahead and expand this. So I'm going to assume that the exemption drops by 50% in 2026. And I'm going to assume that if we don't use all of Bob's estate tax exemption when he dies, that Mary will be able to use what's left. And when Bob dies, I'm going to assume that a credit shelter trust is funded in the maximum amount, which this tells me will be $6,790,000 based upon the assumptions. I'm going to assume that they have already put $100,000 or $1 million into a trust for their children, and that they have 5 children and 1 grandchild, and that they'll be making annual gifts of LLC interests into a trust of the maximum amount, which will be $15,000 a year until that goes up, and then it predicts when it will go up, and that they'll be giving LLC interest taking a 35% discount. So based on that information, I can now tell you that if Bob and Mary go on vacation tomorrow and have done no planning and get into an accident, there will be no estate tax due because they are under 23,700,000, and that's if they die today. So that's the first thing I clicked there. Both died this year, no planning. But if I go to no planning and we show the time value of money, we show that in the first year, residence 2,500,000, investments 10 million. On Bob's death, the residence is worth almost 3 million. Mary's worth 18 million. No planning here. And then on the second death, even using Bob's portability allowance, Mary's estate tax is $10 million. So this $10 million couple did need to worry. Now, I can go back though and say, what if Mary had remarried somebody who did not, and she lost any portability allowance? Then her estate tax would go, you see that, up to 13 million instead of 10 million. And if the estate tax exemption does not drop by 50% in 2026, then the estate tax would go from 10 million to 4 million. So, pretty big swings. Now, the third thing is with some planning, we fund the bypass trust on the first death. I click bypass trust. Now it shows me the bypass trust got 6,790,000 on the first death. That grew to 14 million by the second death. That pulled the estate tax down from what it was, which was 10,000,008, to what it is now, which is 7,000,008. Now, keep in mind that at any time during this conversation, they may interrupt me and say, wait a minute, I forgot our assets are really worth 11 million, not 10 million. What would that change? Well, I just go over here to the left, click up from 10 million to 11 million, and that shows the new result instantaneously on all slides. So then what about if they do the annual gifting? Well, if they do the annual gifting, I click here on annual gifting, and if they did the annual gifting, that makes a nice difference, because that brings their gift trust to 8,000,004, and their estate tax down to 5,000,007. But if they gift discounted LLC interests, not cash, then that brings the estate tax down to 4,625,000. So that's where they are so far. What if we get them some life insurance? So right now, pre-planning, let's say that there is not a life insurance trust. Mary's got term life insurance. She's paying, let's say, 4,000 a year for it. She's going to have to pay it for her whole life. So number of years, way up there. And death benefit, let's say, is $1 million. So that has exacerbated the situation. But with a life insurance trust, it should not be subject to estate tax. So that should save. So you see the savings right there when I click the box for a life insurance trust. So that's how life insurance would show for this couple. Now, before I go to the installment sale, I want to show you a different way to view this. And see up here, the tab Trust Logistics. There's another tab, Timeline. So let me click Timeline. Now, Timeline is showing you the assets of each category in color and what they are each year up through the first death and then up to the second death, and the red is the federal estate tax. So with no planning, you see the life insurance there at the bottom in yellow. You see the home, the residence in darker green. You see the assets in light green, and you see the estate tax in red. And if you want to adjust the date of death of the first dying spouse, you can just move her or move him to change the date of death without having to click on date of death. So then with the bypass trust, you see the bypass trust that forms here in yellow on the first death, and you see where that estate tax happens, and then you see discounted gifting, and then you see life insurance go away. So that's just another way to look at it. I like to use this when I'm planning to just try to decide when to do what. And you could even reverse the orders of their death. Is this cool? Just like that. But now I've reversed the orders of their death. This gives you some of the detail that you're looking at. And this gives you, if you want to know what's going on annually inside the software in the calculations, you can get this from the annual amount mode. So let's go back to Trust Logistics now. And I'm going to show you the installment sale. So I go down here on the left, and I've done all the planning I can do here, and I still have a $5 million estate tax. So what about if I made a seed capital gift here of 250,000, and then I will put, let's say, 3,500,000 into an LLC, and I'll use a 35% discount, So let me see here. Why is this doing that? So I put 250 into the seed capital gift, and I put 3,600,000 into an LLC. With a 35% discount, I can sell a 99% interest in that LLC to the irrevocable trust. I'm going to do a 2% interest rate on that note. It's going to be a conventional note, not a skin. It's going to be a 30-year note for this example. I'm going to allow the trust to pay the income. I'm going to allow the client to pay the income tax for the trust as long as he is living. And this is going to shift some of the income from the married couple to the trust. And that, let's say that that's going to shift 100,000 of their income to the trust each year. So I go to my installment sale mode, and doing that, I see on the top right-hand side, the gross assets within the LLC, 3,800,000, the note owed 2,600,000, net value 1,500,000. By the time of the first death, net value 4,500,000. By the time of the second death, net value 6,500,000. So you can see that saved a lot of estate tax. But I can go back, and I think I need to do more because they're still estate taxable. So I could move the seed capital gift to 500, and I could move the value before sale until I see that there's no estate tax. So that would be 7,600,000 with a 35% discount. The sale is for 4,962,000. Now there's no tax there, but let me look at the timeline. I want to make sure that I avoided tax under all circumstances. And I did. That will avoid tax under all circumstances. Now, this is not to say that I shouldn't do more, but remember, this is only a $10 million couple. And I've had to put 8,100,000 into an installment sale and give them back a 4,900,000 note at 2% interest to completely avoid federal estate tax for them. So starting early was really important. And now, so that pretty much explains the software, but I'll tell you a couple of more things. At some point, the client may say, wait a minute, I don't want to pay the tax on this trust anymore. Let the trust pay its own darn tax. So that is what we call toggling off grantor trust status. So that might happen in year 10. And when that happens, it's going to change the numbers. And then I can change the consumer price index adjustment to the estate tax exemption. If inflation goes up, you're going to have a bigger problem than inflation is lower. And then I can also show U.S. constant dollars. In other words, yeah, you're going to be worth 40 million when the second of you die. What's that really going to be worth after inflation? 22 million. So that's just a sort of a client education tool. So if I want to take a picture to save any of these pictures, I can just go here and I can click Save Screenshot, and the screenshot is successfully saved. And oops, where did my software go? Uh-oh. See if I can find it. Oops. State View.
Alan, it's Kelsey. Would you like me to come over?
Yes, soon.
I'll be right there.
We're going to take a 2-minute break, a planned break, as I try to find a state view on my computer.
In the meantime, Alan, we do have some questions.
Oh, okay, good.
I'll be right there.
Super. I'll go ahead and cover a couple slides. One slide I have here well, no, let's go to another one. This is the amazing numbers when you sell a business that has income. A lot of times clients will put their equity portfolio into an LLC, but not the business itself. So here I've got an S corporation, and besides the salary that it pays the client, it has annual income of $10 million a year, and it's worth 6 times earnings. So that brings it to, there we are, very good. That brings it to $60 million in value. Now, 40% of that would be worth 24 million. But if you're going to take a 33% valuation discount, you could sell 40% of this S corp to a trust in exchange for an $18 million note, paying interest at $180,000 a year. And you would give the trust a $2 million seed capital gift, approximately, if you want to be conservative. So now this trust is receiving $4 million a year, and the client is paying the income tax on the trust. So after 5 years, the trust already has $20 million cash. It's made $900,000 in note payments. So there's $19,100,000 inside the trust when you look at it that way. Plus the stock is still worth 24 million if it didn't go down. So after 5 years, the total value here is 43 million minus the $18 million note. You've moved $25 million worth of value to this trust based on a $2 million gift. After 10 years, you've moved $44 million based upon a $10 million gift. So the slides explain this more, but that's why even if it's a Florida medical practice, we can do this. We could do it even with a legal practice. We could do this using a management company. So, all right. So for some reason, I apologize that my computer booted this thing out of existence. Let me give it just some numbers so that we have something that we're showing you. Portability allowance gone, and let's give them a house. Everybody needs a house. They can't live in their cars. And then we can do the installment sale. Okay, so the last feature I want to show you here for this part of the software is the generate client letter. I click here, generate client letter, and a letter has been drafted. This is my favorite part of the software because it saves us so much time. Because here's a memo to them. It explains the estate tax system, and then it gives all the inputs, and then it explains how no planning works and what the picture is for no planning and what the bypass trust is and what the annual gifting is and the discounted gifting, et cetera, et cetera. So the software is not perfect by any means. It does not do state taxes. It does not do a single individual, although you can kind of jury rig it pretty easily to do a single individual. I'm going to show you the other module we have here. And I'm happily surprised that about 80% of the attendees are still on, which shows that they are sleeping or tape recording this and not really listening. But this is a separate module that allows me to input these items. Let me see if I can, oops, call this up again. Installment sale calculator. Fit width. All right. So I'm able to input what this client's assets are, and it's a single client, what the assets will be without a promissory note, what the annual growth will be on the assets, what the client's annual saving or spending is, and that's important because you don't want the client to run out of money, how much the note payment is, how much the income tax is that the client will be paying, what their taxable estate is as a result of this, how much their exclusion is, and what their estate tax liability will be each year based upon the installment sale situation. And then I can show what the estate tax savings is from the installment sale situation. And then from the point of view of the trust, I'm able to show the assets of the trust, the note balance until it is paid in full, the growth in the note, that the trust did not have to pay any income tax because there was no toggle off, the annual payment on the note, the net assets in the trust, the net assets if the grantor dies, if you're using a self-canceling installment note. So we have inputs for all of those. They're click up and click down inputs for each of those columns to help the client understand how the installment sale works. So that's the makeup of the Estate View software. By the way, it is dual screen software, so I can move these things around. Let me see if I can hit float, and then I can move this around. So I could move this to my second screen or my first screen or my left or my right. It's all adjustable. Very interesting what you can do with software nowadays. So that concludes our 40-ish minute presentation. Are we going to do one next week? I'm sorry, I don't know, haven't decided yet, but probably so if you're interested. Thank you very much for your questions, comments, and suggestions. You've got our email addresses there. As always, please send the difficult questions to Brandon, the easy questions to me, and have a fantastic rest of your weekend. Thank you.